Good morning, good afternoon, good evening, and welcome to the Monday the 14th of March Bull versus Bear webinar with Steve Miley on the call for TradeDay.com. So welcome everyone. We'll go through our usual normal run through in here today. We'll look at what we've had, what we've got coming up, take a look at the calendar. We'll do the run through for the week as well. I think it's, I've said this on many occasions here on the webinars. I think it's really useful over the weekend or on the Monday to take a look at what I like to call the shape of the week, to see where the potential volatility points might lie in the week. And then you can get a better understanding of how volatile the market might be today. We're day trading here at TradeDay.com. But nevertheless, it's good to have an understanding of if the market could be more or less volatile. Now, I appreciate that in the current scenario, geopolitical risks are very, 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 very high. So the markets are very much being dictated by that too, to some extent. Nevertheless, we've got some big stuff coming up this week, and I think it is important to take into consideration and to get in good process, right? Good processes, good habits, good behaviors. Do the right thing. Do the right thing, and the behaviors. If you have the right thought process, the right behaviors, and the behaviors reflected back into your thought process, and then you build a good way of approaching markets. So I think this is a really solid approach to be taking a look at what we've got coming up for the week. So you can download this. I'm not going to go to the traders. The trading room. If I go to the trading room in here, you know where it is. If I go to the main page, you click here into the trading room. If I go to the trading room, obviously the webinar is streaming live and we'll get a load of feedback loop. So I'm not going to go there, but it is, if you go to click here to the trading room, you can download in here. So not only on the market research area, we have the daily updates. That's my technical analysis reports from market chartists. But over the weekend, I put up this weekly recap as well. So this is initially a recap. So what's gone on, well, we know what's gone on really. Markets being dominated by the geopolitical risk from the Russian invasion of Ukraine, shifting between risk on and risk off. We've got the sanctions and the impact from the sanctions. We have global commodity prices, which have been surging higher, but did have a significant setback in here from the middle of last week. So still very, very volatile. An ongoing inflation pressures from surging commodity prices and underlying inflation we had anyway, and the spectre of negative impact on growth rates from the conflict and from the sanctions, raising the spectre of stagflation. And stagflation is stagnation combined with inflation. So you normally don't get both together. You usually get inflationary pressures when the economy is very strong and is overheating. So the economy is strong, growth is strong, you get inflation. And then on the other hand, then you might get, when you have weak growth, you usually have low inflation. However, sometimes, and it hasn't happened for a very long time in the major global economies, you have to go all the way back to the 70s, maybe early 80s, where you saw low growth rates, recessionary pressures, alongside high inflation. Okay, and there is a real spectre of some stagflation coming through going forward. What we got coming up this week, I'll let you read through this. I'm not just going to read it out for you. There's no point in that, and you know what's happened in markets. You can look back yourself on those. One thing of note is the US has moved to daylight saving time this Sunday just gone. And that means if you're in the US, nothing changes for you, right? Exchanges that we are trading are based in the US, the Chicago exchanges. Therefore, you're not going to see any impact on any change in the hours that you're trading. Yeah, things stayed normal for you. If you're trading outside the US, particularly if you're trading in the UK or Europe, what you will find is that there's a difference in time now. Yeah, so previously, normally, for example, between GMT and the time in Eastern time in the US, New York time, is usually a 5-hour difference, okay? With Europe, with the UK, 5 hours, GMT, 5 hours ahead of the time in New York, Eastern time. Okay, at the moment, because of the change, and in UK, Europe, we don't change to daylight saving time until another 2 weeks. Okay, so it's on the 27th of March. And so for the next 2 weeks, we're only going to have a 4-hour time difference between GMT from London time and looking at New York Eastern time. And so now usually 6 hours to Chicago time, now only 5 hours to Chicago Central time. There's when the exchange is obviously Central time in Chicago. So please do bear all of that in mind with the opens and close, because if you're in the UK or Europe, the open and close are going to be 1 hour earlier for the next 2 weeks than they previously were, and that could have an impact on you if you're taking the evaluation challenge. So do watch out for that. So what have we got coming up? Well, I've already put in here the big data release for this week is going to be the US retail sales number on Wednesday. But before that, after, we do have four central bank events. So we have the RBA, the Reserve Bank of Australia meeting minutes. Now the RBA have stayed relatively dovish. They see the problems from growth, negative growth impacts are potentially bigger than the issues coming from inflationary pressures. So they've stayed relatively dovish. However, they could shift on that. Now, that's not going to necessarily, unless you're trading the Australian dollar, impact any markets you guys are trading. However, it could have a little bit of an impact because, the more other central banks, move to a more hawkish stance, can have an impact on global bonds, equities, and FX markets. So do keep an eye on that. I think it could be interesting here. We also get Chinese retails. So, by the way, nothing of note today. Today is a very, very light calendar, not just in the US, but globally. Okay, so RBA meeting minutes, they actually come through overnight. So if you're in the US, you actually catch them at the end of the day today. We also get Chinese retail sales tomorrow, the UK employment report. That's a big deal in the UK, but probably not so big on the major global equity markets. We get the German ZEW survey. That can be significant sometimes. And US PPI data hasn't really been impacting markets too much of late in here. That's all on Tuesday. The biggest probably data event of the week is the US retail sales that we get on Wednesday. We get Canadian CPI also Wednesday. And then the big really macroeconomic event of the week is the FOMC press conference, the rate decision statement of press conference. Now, the market here, if we look at the tool in here, going back to 16th of March for Wednesday, it's pretty much nailed on. We're going to get a 25. So the current target rate is 0 to 25. It's going to go to 25 to 50, which is up 25 basis points. Okay. Only a very slim chance that they leave it unchanged, and here is being priced in. So very little chance of that. If we go forward though to May, if we look what we're pricing in for the May meeting, we're currently obviously at 0 to 25. So May is pricing in very little chance that we're only going to be up a quarter. Okay, because we're kind of nailed on that we're going to be raising a quarter in March. And now they're pricing in at least 50% pricing in for another 25, and nearly, just under 50%, 46, over 50%, 51%, and 46% markets pricing in for a bigger rate hike in the May meeting. So maybe going, 25 this time, and then there's a good chance we're going to be definitely going 25, and a good chance of going 50 at the May meeting. So it's going to be really significant to watch how hawkish the Fed are. The market is pricing in a far more hawkish Fed, that we're going to be, good chance, 50-50 chance it's going to be at least 25 basis points at the next meeting in May, not this meeting coming up this week, the next meeting in May, and potentially coming up to a 50%, almost 50% chance of it being a 50 basis point. Now, if the Fed are not particularly hawkish, if their stance is a little bit more dovish, if they start talking about the situation, which they almost certainly will mention geopolitical risks, okay, if they start talking about that risk to growth, this could easily switch to this being 100% to going towards more like 25, and even maybe some chance of no move in here, and this column in here falling down, that we won't get a bigger hike. And if that is the case, if the market kind of shifts that way, if the Fed dot plot chart, if the Fed statement, if the press conference is an indication of a slightly more dovish Fed, that could then see a significant move in bond markets. Now, bond markets are very much in here. If we go and take a look at bond markets in here at the moment, I've got the S&P up here, but if I go and take a look at the bond market, actually I need to redo the S&P. See the bonds in here. This was from Friday's bond move. Okay, no, sorry, it's today. This is today. Excuse me. This morning's bond move. We've broken down through the lows in here. Okay, so yields in here higher at their highest levels. Yeah, super high levels in here. So in here, the market is completely. Before we got this rally, when the invasion came, we got the rally higher in bonds, safe haven bid. People buying bonds as a safe haven. But since then, the inflationary and stagflation pressures are so big in here that now we've moved to new low prices in here. This is the June contract on the 10-year note. Okay, so this is telling us, right, that the market is very, very worried about inflation. It's very worried about a more hawkish Fed. Now, if the Fed step away to a bit more dovish, you could see this market reverse. Now, the concern is that if the Fed don't keep hold of inflation, this will go even lower, right? So it's not just a reflection of interest rates. Remember, this is a reflection of inflation as well. So we could see markets going lower in here as well. But if there's any kind of hint that the Fed could switch to slightly more dovish, then what we're likely to see is that dovish shift be positive for stocks. Okay, and we'll come back and look at that shortly. Let's go back to where we are here. So what we're looking at. So it's the Fed. So it's all about the Fed on Wednesday. That's the big event. New Zealand GDP, Australian employment report. Then we get another central bank event Thursday. The Bank of England. Now remember, the Bank of England are actually ahead of the Fed. They've hiked twice. They hiked last year and this year as well. Are we going to see further interest rate rises from the Bank of England? And then on Friday we also get the Bank of Japan as well, but not expecting anything really significant there. So that's the kind of tale for the week. And looking at the daily calendar, you'll see there's nothing really of note in the daily calendar. We do overnight get the so this is late tonight RBA meeting minutes, late tonight in US time, and then actually going right into the night, we've got the Chinese data. Okay, so what has been going on? Well, we kind of know this already. I don't know if, well, hopefully you guys know this, but, you know, over the weekend there were some slight positives at one point. Okay, so stock futures were up. And if we go and take a look at the S&P, and what I'm going to do, just going to put a note as well to you guys. The more now the liquidity is getting split. We're rolling from the March to the June contracts on the equity indices. So you could trade either the March or the June at the moment, but probably best to be trading the June. The more of the volume now in the June contracts. So up here on your in my tabs, you see I've got the March contract in here, ESH, and then NQH. Okay, you want to be flipping over to the June contract. So I'm going to put those in and upload those in here now. So ESM2 is the June 22 contract. Okay, so I'm just going to load all these in here, and now I'll have two in here. So then we've got the I have the daily chart as well. And then I'll also add in the NASDAQ chart as well. So I'm going to do the analysis on here on the June contracts in here, guys, okay, from going forward. So if you mean there's no reason you can't still trade the March contracts, because they are very liquid still, but as the week goes on they expire end of week. So as the week goes on they're going to become less and less liquid. So my advice would be to switch over and start trading on the June contracts from now going forward. Okay, you can, and I will be doing the analysis, so just so you're aware when I'm talking about the levels will be on the June contract. So I'm actually going to close all of these March contracts down now. So sorry to do this while you're on, but just get them out of the way, and then they're not going to disturb us going forward. I'm not going to start looking at the wrong charts and giving you different levels. So we're going to be looking at June contracts in here going forward on the equity, on the stock indices. Okay, so let's take a look in here. So what we did have seen overnight in here is the markets from over the weekend. We've seen the market spike back higher, okay, in here. And if you look in here, what we're seeing, I'm going to get rid of a lot of this old analysis. Is rolled the analysis on. But what you've seen in here is the market has pushed back high. You can see it come back all the way back to where it opened. And the reason for the push higher was we did have some positive soundings from the out of Russia, Ukraine, or particularly from Russia actually, over the weekend, that talks had made some progress. They're the best thing we've seen on the talks recently. So if we go and look at 5 things in there, look, and the Russian invaders continue their attack, but okay, signs that the negotiation may be starting to make some progress, and that came out on Sunday. In here, European, so Russia told further talks project trades remain on edge. Okay, it's not really gone here, but they did so. Headway, easing tensions as potential Russian supply goes. Okay, no, so it's not really covering it here in this article. But suffice to say, there were some positive soundings from the Russian side that there had been some progress in talks. However, you can see the market back lower in here. If I go back to the chart in here and go look at the 30-minute chart, you can see the market has slumped back lower in here over. So it's been resilient in here overnight, recovered in here. It's a 30-minute chart on the June contract on the S&P. You can see the market's recovered in here through the night session, and then in the last couple of hours we've seen a slump back lower. Now I think that's been driven by this in here. So this came out, well, actually they're only posting this about an hour ago, but from the Kremlin, all Russian plans in Ukraine will be fulfilled and in the time frames outlined. Okay, so as he says in here, look, so much for the so-called peace and ceasefire in here. So the remarks here continue to underscore that nothing has changed. So markets kind of got themselves a little bit bullish. We went into like risk on mode. Stocks went higher on the night session in here, and that's despite, and I'll talk about the rout in Chinese stocks as well. But then the market in the last couple of hours in here sold off. By looks of it, things not progressing as well as maybe had been indicated. So yeah, talks is one thing. There's been a big lockdown in China. 17.5 million residents of Shenzhen in here into lockdown for at least a week due to COVID-19. And then in here as well, oil backed off as went lower in here. But again, again on those talks, if we go and take a look at the oil chart in here, actually still low, but it has had a slight rebound. But the oil did go lower in here through this morning because of those. So oil lower because of the peace talks. Okay, so a positive, obviously for positive for supply potentially, and taking the pressure off of oil. So oil back lower on the back of that. But if we step into like I've got an hour chart here. Let's step it to a 30-minute chart. You can see that oil has rebound again on those comments from the Kremlin. So we've seen oil back higher in the last hour or so. So let me go take a look at the other finish up in here. So China in here. So we did get a big sell-off. So in Chinese tech stocks in here, plunging lower. Let's find the article on that. So no. So here we go. Panic selling grips Chinese stocks. Biggest plunge since 2008. Massive sell-off in Chinese tech stocks in here. Now, not having a contagion effect. Contagion is obviously when it spreads to other markets. So not having a significant contagion effect in here. And so the geopolitical risk saw US-listed Chinese shares slump on Friday. So stocks were lower on Friday and again lower in here this morning. So certainly a big negative in here, and partly to do with Beijing's close relationship with Russia in here. And so that's seen a negative, but really not seeing a flow through into US and Europe today. So if we look at actually European stocks, it says stocks mixed in here. Asian stocks were kind of lower, but the Japanese stocks were higher overnight, and European stocks high this morning, and up to a point more recently, US and European stocks high this morning. So we're going to look at European stocks in here. Where are we in here? So you can see up between 1 to nearly 2% in here, between 1% to 2%. The main European stock markets all up in here this morning. And if we go and take a look at the US, despite US stock indices being down on Friday, rebounding in here this morning, so up about 0.5%. But NASDAQ now down. Okay, so these were up about 1%. The Dow and the S&P were up around 1%, 0.9%, 1% up on the day, and the NASDAQ a little less, about 0.6 up in the day. NASDAQ underperforming because of that bond move. Remember, we looked at the bond move, lower prices, higher yields, higher interest rates are not as good, are more damaging for growth stocks, and NASDAQ is obviously for the growth stocks. So an underperformance from the NASDAQ in here. So we do have the Dow and the S&P 500 still up on the day in here, still up on the day. On the futures, but the NASDAQ in here down in here. Don't know why I'm getting that. So let me just exit those pages anyway. So then we covered the Chinese stocks. Panic selling grips Chinese stocks. Biggest plunge since 2008. We've spoken about that. What else do we have in here? Tentative Ukraine peace hopes lift stocks and bond yields. So again in here headline from Sunday really coming through and this morning. However, since then we've seen some kind of denial. European stocks rise with Fed Russia-Ukraine talks in focus. So we have had a positive spin so far this morning. However, over the last hour or so, things have turned a little bit more negative because of this. Yeah, all Russian plans in Ukraine will be fulfilled. So that's kind of pushing back a bit against what was said previously. Right, let's take a look at some charts in here, and then I'll wrap us up. So let me first kick off. We'll go back to the stock indices. So for me, the market is just trying to put in some kind of basing pattern. So it was a fairly weak close at the end of the week on Friday. Market was obviously strong at one point. Again, we had positive soundings, remember, from Putin, and then they kind of got erased through the day, and it was a weak close on Friday. And then again this morning, we've kind of rebounded and faded. Now we are in a bigger picture, lower, higher highs and lower lows and lower highs. It does look negative, but you did manage to hold last week above the spike low from the end of February. We held above that at the beginning of March last week. However, for me, if you asked me 2 hours ago, I'd be slightly positive again going into today. But given that the market's rolled back lower, it's a little bit of a concern. Let's zoom in on the June chart. I think as long as we're holding above Friday's low, and we've just about held above this low in here, this little swing low that we had from Friday. So there was the low from, actually, no, sorry, this is the low in here from early in the week, from Tuesday. Then we held in here, there's Friday's low. Whilst we're holding Friday's low, I think we cling on to a bullish tone. I think this is potentially a base forming. So you've potentially now got a triple bottom, 1, 2, 3 lows in here, and but you need to get back above today's the overnight high. Okay, so it's still a fair ways to go, but nevertheless, for me, this is setting up fairly positive. And I think you've got a really clean exit. You just exit below the low. So the low in here from Friday was down at 42.0875 on the March contract. Here we are, 42.1175. Oh no, that's wrong number. Sorry. Sorry, I'm going to recap that. 42.0025. Actually, no, we just dipped below. So just above 4,200 was the low from Friday. We got to 41.99.5 and then rebounded. So it's just hanging in, just holding in here. I'm trying to rebound now, despite the sell-off we saw a couple of hours ago in here. So for me, I'm still just about clinging on to a positive tone. If we start to break back down below either this low, certainly below last week's low, this all turns very, very negative very, very quickly again. And a similar story if I go to the NASDAQ in here. So the NASDAQ in here, these are the lows going all the way back to, 2 weeks ago. There's Friday's low, okay. Where are we? Sorry, that's last Tuesday's low, excuse me. That's last Tuesday's low. Here's Friday's up, and we made a new low in here today through those lows. So that is worrying, more than worrying for the NASDAQ. The NASDAQ's certainly looking more vulnerable than the S&P 500. But nevertheless, look, rebounding right in here right now. I think you're not going to get a real true feeling about where this is going until the cash market opens. For me, I'm clinging to a positive tone, but quite happy to flip that to negative if we start breaking down below the current lows for today. Let's take a look at we already looked at these tentatively already, but let's take a look at oil. So in here now, oil, since the blowout top, remember we had that double top pattern we looked at, double top, big sell-off in here through last week, and then the market has been kind of oscillating, but lower lows and lower highs and lower lows in here, and made another new low now, rebound. I think this is probably a sell opportunity. You've got this kind of tentative trend line in here, runs across. This comes from the 10th of March through the peak in here, from the 11th of March. If I extend that out, if the market can stay below here, I think, playing this from the bear side, right? So there's an opportunity to sell somewhere between where we are now, between like 104 and 106 to sell, and then maybe a stop above this little swing swings actually from this morning. So the swing there from this morning high is 107.07. Maybe try and establish a short between 105 and 106 with a stop at 107.07, because then above there you'll also be above this little down trend line. It's a good little trend line. 2 touches, draw it off these points, you get a third touch here, and it impulsively moves away on that third touch. You see, someone just goes and touches and moves away. So yeah, I think playing it short whilst below there. And let's take a look at gold as well. Oh, sorry, leave that up big. On the daily chart, so you can see gold lower again in here. So following that that theme in here of risk off in here, sorry, risk on, so the market back lower. So equities are suffering a little bit in here, given that gold and oil, remember there's been an inverse relationship. So gold up has been safe haven, gold down, more risk on in here. Oil down has been more risk on, and gold in here back lower in here this morning. And if we step in from the daily to the 30-minute chart in here, yeah, looking vulnerable, lower, similar, not dissimilar chart to oil. Got the topping pattern up here, sold off, and then lower lows and lower highs, trying to rebound again for oil. Gold in here probably looking until somewhere between 1970 and 1980 with a stop above maybe these overnight little peaks in here, 1982, 83 kind of area. So 70 to 80 sell zone, tight stop 82, 83, maybe just above there. And looking for this to go lower. And that's given we go back into risk on. So equity markets are just clinging to risk on, but NASDAQ does look a little bit vulnerable. All right, everyone, I'm going to wrap it up there. I'm going to wish you all as ever a great trading day. Please do stay safe out there. I'll be back with you with another bull versus bear webinar tomorrow.